Oh. I think putting more, like, a little bit. I don't know. Yeah, that would be perfect. Yeah.
Was that lemonade or water? I think it's just water. Okay, looks like a little bit of yellow. Yeah.
Hi, folks.
And there's also
And then it's like,
Hi, everybody. If you could take your seats, please. Hi. Welcome. We're live streaming today, just so you know, that's why I have a mic. So yeah, you're tapping the mic because you're wondering, is it making any noise? It isn't, because it's not actually broadcasting in here. It's only broadcasting out there. So don't worry if you don't hear the mic. And when we get to Q&A portion of the thing, we'll have a mic going around for folks who are in the audience to ask questions, so your questions are heard outside of this room. So hi, welcome. For those of you who don't know me or haven't been to Philanthropy New York before, I am Michael Romali. I run our communications and public policy programs here, and it's my great pleasure to welcome you to the future of finance, shifting power and wealth from Wall Street to Main Street. Main Street. This is part of a larger series on how philanthropy can help shape the new economy. So the first, how many do we have now? This is the second? Third. Okay. So these have been very productive and wholesome discussions, and I've found them very enlightening, and I think that this will be another good one in the series. So I am going to hand it over quickly to Richard Healy, who is going to introduce our wonderful speakers. He is the executive director and founder of, oh my gosh, I lost it somewhere. Thank you. Very bad. I'm like the worst introducer in the entire world. So I will end my very poor job of introducing and hand it over to Richard. Thank you for being here.
Thank you, Michael, and thank you, Philanthropy New York. I'm also, one reason I'm here is because I'm on the board of the C Forward Foundation and advisor to the Solidago Foundation, and that's the other role that probably got me more directly here. I want to thank Philanthropy New York for hosting this series, of which this is the third, and particularly I want to thank the Edge Funders Alliance. I don't know if anyone from the Alliance staff is here. I don't see Mark Randazzo, but they have really conceptualized this series and promoted the set of ideas and really held the idea of the new economy very closely. They've also produced a film, which there will be more installments, I'm told, that is intended as an introduction for those of you who are not familiar with these ideas, and the lucky few who have not seen this before. We're going to actually show you a short film, 5 minutes and 40 seconds, Crystal told me, that helps introduce the series. So Crystal, if we can see that now.
There's a lot of talk about the economy these days. Some people say the economy is taking up. Some people say it's tanking. If you really want to make sense of the economy, it's useful to take a big step back and ask yourself, what does economy mean? But the heart is this tiny little word, eco. And eco means ecosystem. It's all of the complex relationships involved. Ecology is the knowledge or study of all. And then you get economy. Economy is simply the management of all. So there are three basic pillars that are true for all economies. You need resources. You need land, air, water. You need the living world around you. The second pillar is you need work, you need labor to combine with those resources to produce them. And then you need a culture, a cosmology, a worldview that tells us what we can do with our labor, towards what ends with the world around us. Then what are the pillars of the dominant economy? It's all understand. Well, we get our resources through extraction. We forcefully remove them. We get our labor through exploitation. Resources and labor have to be acquired at the lowest possible price. And the culture is one in which we can have endless and infinite growth that denies the real ecological and social consequences towards one very particular end: the accumulation of greater and greater monetary wealth and power. The big corporations are being governed really for the benefit of the CEO. It's not even for the shareholders anymore. The same way that the basis of modern production is extraction from the planet, modern finance is extraction from the larger community towards the financial community towards 1%.
This is not only an economic issue about who's getting money, it's also a racial issue, it's also a class issue.
This economy often leaves out people of color, immigrants, minority communities, women.
So the question is, if the extractive economy is what got us into the mess we're in right now, can it get us out? Not likely.
What is required is fundamentally to transform the infrastructure structure.
The depth to which corporations are integrated with the economies around the world, meaning we absolutely have to say at the global level, the international level.
We need to explore new ways of managing power.
The new economy has to step away and then push back at those old pillars, because it has to be a new economy that puts people before profit, that puts planet before profit.
The first pillar is to rethink our relationship to resources.
There's simply no way that we can have this endless, limitless, infinite growth on what is actually obviously the finite planet.
The second pillar has to replace the exploitation of human labor with a recognition that when we take our labor and apply it towards economic well-being, we can create a new cycle that's based on regeneration. That requires a new theory, a new way of imagining our relationship to each other and to home. It's not only possible, it's happening all at once. One of the most inspiring things is that there are people, groups, all over the country and the world who are organizing both to meet people's needs and actually confront the systems that are under the presence.
Underlying all of it is the small group democracy.
I think it could actually change the way things are going, to have people actually participating in the decisions that are done in their lives. Any economic transition has to have this notion of restructuring the way we think about ownership.
That demands some political muscle, some organizing muscle, and some idea muscle.
How do we develop new business models that create more local ownership and more democratic ownership?
Even philanthropy is looking to change.
The greatest task philanthropy has is not simply to give to what exists, but to the greatest task philanthropy has is not simply to give to what exists, but to reimagine what is possible.
Well, the basic thing we're talking about is human consciousness. Without a sense of self-awareness, in the sense of how we behave, how we think, how we understand the world, and how we form relationships. And the extent that we start transforming those understandings and those relationships, that's part of forming the new economy today, here and now.
By looking at how we live, we can find how we can live better, more interconnected lives, and simultaneously invest in and build the economy we know we need, and maybe even be happier for it.
So that's the work of the Edge Funders Alliance, and we owe them, in spite of their sometimes bad casting decisions, which I have to admit to. So I was asked to say one more word about this series, which was that we have 6 very disparate topics, from small business to democracy to climate to food. What holds it together? Why did we conceptualize it as a series? And the answer is that if you read carefully your invitation, then you saw the word system used in a number of times. Systemic problems, the system is a problem. And it's what that word connotes, it really is what's going on and trying to hold these things together. That though each of these are distorted, they're distorted in ways by a system that underlies them. And I would point towards, and as I think about it, it's in terms of power and the market. That in our society, power is held unequally and badly, right? So that if you want to understand small business, you can't understand it without looking at the discrepancy in power between Walmart and your local community businesses, right? That's not a market relationship in the usual sense. That's a power relationship. And secondly, the market. So there are people more qualified than I to talk endlessly about that today. They will be brief. But that the thing that holds this together even most closely for me, these 6 topics, is the fact that the market is really inappropriate to deal with 3 big areas. With human beings, labor, right? That's why we're about work and jobs and competition and inequality. It doesn't deal well with labor. It doesn't deal with land and natural resources. How do you price the sky? How do you price resources? How do you price land? Right? Land is not a commodity. And third, and most directly germane to today, the market does not deal well with money as a commodity. Now, I am taking that directly from Karl Polanyi, who I think is very relevant again today, and I recommend the new book, The Problems of Market Fundamentalism by Fred Block and Peggy Summers, that I think are very helpful as those of us are struggling to understand these different aspects and what to do about them. I think that level of analysis is enormously useful. Having preached that very short sermon, I will turn this over to Anna Leffer-Kuhn to talk about this specific session.
Great. I'll grab the
You should. I should give you this one. We're in the sharing account.
Share the mic. On behalf of the ARCA Foundation, I'm Anna Leffer-Kuhn. I'm the Executive Director of the ARCA Foundation. And on behalf of ARCA, the Ford Foundation, Jean Ross and Amy Brown of the Ford Foundation, and Bill Dempsey of the Nathan Cummings Foundation, I want to thank you all for joining us here today. When I heard from Leah Hunt Hendricks, one of the leaders behind this series almost a year ago, about this project and in the series on the future of the new economy, I jumped at the opportunity to participate. As a funder working on issues of financial reform and Wall Street accountability, I've spent almost 6 years engaged in discussion about the role of financialization in driving inequality. Although the business sections of every newspaper tells us we're in a recovery, you all know that that recovery is only relevant in the lives of our country's wealthiest, and that most Americans, 99% of Americans, are experiencing record levels of debt. You know, whether it's the 1 in 5 homeowners who are still underwater with their mortgages, whether it's the millions of families across the country that are facing over $1 trillion of debt due to education and college. So, you know, I was really excited actually to participate in a discussion that is focused on solutions. You know, the problems of financialization seem overwhelming at times, that they can even seem intractable. But there actually are some opportunities to move the dial on these issues. And today we're going to have a discussion that is actually both hopeful and innovative. We will certainly spend a portion of this afternoon looking at and discussing the impacts of financialization on the real economy, but we will also speak with activists who are building power to drive real and achievable solutions to these problems. We're going to examine ways in which activists are working to make the financing of cities, higher education, and home ownership more democratic. And we're also going to spend time exploring new models of finance that move resources toward Main Street, as opposed to extracting wealth from communities and into the coffers of Wall Street. So before we begin, I thought we had a small enough group Do you think we could quickly, or should we go around and say everyone's name? Yep, I think that would work. So should we pass the mic? I thought before I just quickly introduce the panel, you got it? Okay, but I thought it'd be good to do that.
Michael Romali, Philanthropy New York.
Katie Toolin, Unbound Philanthropy.
Hannah Sun, Crooked Island Foundation. Andrea Scholler, the Tau Foundation.
Maureen Dabu, the Commonwealth Fund.
Jennifer Arietta, North Star Fund.
Amy Brown, Ford Foundation.
Teresa Khan, I'm an independent consultant and I have a couple of foundations.
Richard Healy, Grassroots Policy Project.
Lisa Donner, Americans for Financial Reform.
Maurice Weeks with the Alliance of Californians for Community Empowerment.
Sakib Badi of the Nathan Cummings Foundation.
Mike Hansel, Roosevelt Institute.
Brad Miller, Center for American Progress, and the law firm of Grace and Ellsworth.
Anna from ARCA.
Zoe Hudson, Democracy Alliance.
Alicia Wong, Roosevelt Institute.
Buff Kavelman Group Philanthropic Advisors.
I'm Karen Colbert from the Harry Guggenheim Foundation.
Farhad Ibrahimi, Chorus Foundation.
Laura Rissamini, the Sister Fund.
Violet Lee, the Sister Fund.
Chen Shah, Ford Foundation.
Jessica Brackman, New Economy Coalition.
Nellie Abernathy, the Roosevelt Institute.
Aaron Labrie, Overbrook Foundation.
And Daniel Rajendra at the Neighborhood Funders Group.
Great, thank you everyone. I know we have some folks on who also joined us via live stream. So are they able to introduce themselves? No, okay. Well, welcome live streamers. I didn't know how advanced the technology is. Okay, so we had a chance to learn the names of our speakers, but I'm just particularly pleased to introduce them all to you because I really feel like they're four of the leading activists and advocates working on issues of financial reform. So just briefly, you all have seen their bios, but Lisa Donner is the Executive Director of Americans for Financial Reform, and her organization and her in particular have been essential to the passage of Dodd-Frank and the implementation of financial reform over the past 4 years. Lisa, along with leading that very challenging charge where the financial services industry was putting hundreds of millions of dollars into blocking that legislation and into blocking any implementation of that legislation, Lisa has also played an incredibly important role resourcing activists across the country who are leading innovative campaigns that are looking to create a more just economy. After Lisa, I'm not going in the direct order, is Mike Hansel, who is a fellow at the Roosevelt Institute and who has been a really important public intellectual and communicator who has taken who continues to take many of the most complex issues of finance and markets and the economy and explain them through his writing, his blogs, and his work with activists in a clear way that is relevant to the lives of all of us and help support some of the key campaigns that you'll be learning about here today. Next to Mike is Sakib Badi, who is currently or soon to be ending his fellowship at the Nathan Cummings Foundation, where he will then begin a fellowship with the Roosevelt Institute and will also be the future director of a new project called Refund America, which is going to support campaigns around advancing a more just financial system for municipalities and cities. Sakib comes to this work through his work as a campaigner and researcher at SEIU, and he has been the hub for much of the campaigning you'll be hearing about today. And last but certainly not least is Maurice Weeks, who's the campaign coordinator at Alliance of Californians for Community Empowerment, otherwise known as ACE. And Maurice and ACE have been at the center, have really been the driving force of the campaigns we're going to hear today, whether it's on rethinking new models for housing finance in cities throughout California, as well as driving some innovative work around higher ed finance. Maurice has been at the center of those conversations, especially in the area of education finance, and where we're seeing a lot of innovative new young leadership. So we're really excited to have you here. So I will turn it over to Lisa, who is going to be our moderator for the afternoon.
Okay, great. Well, thanks to all of our hosts and to all of you for being here. It's a pleasure to get to talk about these things and to do so with my colleagues in this work. I'm going to take a second to frame what we're talking about and then begin the panel proper. One part of the way I think about why this conversation matters so much, to state the obvious, but obvious that gets lost too often, is that we just lived through a financial crisis that cost tens of trillions of dollars, that impoverished hundreds of millions of people, that increased inequality in the US and across the world, and that expanded the racial wealth gap, just to start listing the toll that it took on people's lives. And I think there are a couple of pretty important lessons to be taken from that. One is that the financial system matters. The rules about stuff that sounds obscure, like derivatives contracts, and the preferential treatment of derivatives in bankruptcy, for example, or capital or leverage levels matter. They sound technical, but they play a huge role in determining our economic fate and future. And the second, again, to say the obvious, is that we can't leave it up to the companies who make a profit in this business to make the decisions about how these rules should be written. And for decades, we essentially did. Decades of deregulation where we let the firms who have very specific and narrow self-interest in their own profits guide decision-making about these incredibly important matters, and the results were disastrous. So we need to do things differently than that. We need to understand how the financial system works now and how we think it should work. What's it for? What should it be for? And what do we need to do to make it be for that? We need to change the rules so that they work to support a more equitable and sustainable economy. And we need to do the organizing so we have the power to actually make those changes. And then I'd say, as the transition to the first part of this conversation, as many of us have dug into thinking about the financial system, and again, this is obvious, I think, but important, the problem is not just that an out-of-control financial system causes crises every so often and with some regularity, although that's a pretty serious problem in and of itself, and those crises are disastrous. It's also that a financialized economy, an over-financialized economy, undermines prosperity and equality day in and day out in a large number of ways. It gets in the way of, it distorts resources from, it perverts attention to and the possibility of an economy that works better for everyone. So I think that there's relatively little history in some parts of the world of engaging on these issues, but we need much more in all kinds of ways. So the first part of our conversation today is going to be some more exploration of financialization and what that means and looks like. And then we'll pause after that to take some questions and discuss that a little bit. And then the rest of the conversation and more of it, as Anna suggested, will be about solutions and campaigns that are underway and opportunities to make change and progress. So with that, do you want to start, Mike, with telling us what financialization means?
Sure. So I'm speaking in this. So can everyone hear me okay? Thanks again, everyone, for having me here. I'm very excited to be working, talking about these complex issues and trying to break them down and trying to think of solutions. I think it's very helpful to step back and think, especially if we want to talk in terms of video, in terms of a new way of envisioning the economy and understand what has perhaps gone wrong in the economy. It's important to understand and put some meat on a definition of what financialization is. It's a term like inequality and globalization that we use, but it's very difficult to get a really concrete definition of what it is and what should concern us about it. And for us, I think it's always helpful when we want to think about ideology like this to just read the business press, which is usually actually very flamboyant with what's going on in the economy. And there's a great story about, I don't know how many people here own an iPad or a mini iPad or any of the numerous tablets that are out there, but of course this was invented in 2010, and there was a remarkable story that came out in Market Watch, a subdivision of Wall Street Journal, and hold on, make sure I understand this works. In Market Watch, January 2010, this is when it was rumored to be coming out, and the iPad name wasn't mentioned. A opinion column, and this was in the Wall Street Journal, it's one of the main places of finance, said, you know, the biggest innovation they want to see from Apple isn't an iPad or an iSight or an iTablet. It's called the I Get Some Money Back. The money that Apple is going to spend on tablets or innovation or hiring engineers to come up with new products to meet new needs was not what Apple should be doing. Apple should be taking that money and giving it to the shareholders. Apple should indeed go even further and borrow money to return to shareholders instead of this iTablet or iSlate or whatever it would end up being. And we can, of course, laugh about it because it's a pretty funny story, right? You know, the iPad is intensely successful. There's a lot of other people who are trying to keep up with it. You know, phones are starting to look like tablets and all. But of course, the last laugh was on Apple because 2 years later, under activist shareholders, Apple did exactly what that advice was, and it started to borrow money to buy back its shares, to release a quarterly dividend. And it really kind of shows the mentality of things like the shareholder revolution. So financialization, what kind of things are changing the economy when we say that the economy has become more financialized? I think there's 4 overlapping and interlocking trends. And we're going to go through each of them, and then we're going to kind of discuss them more broadly for the rest of the day, because I think it will influence how we talk about each individual thing. We have the shareholder revolution, which we just alluded to. We have the growth of the financial industry. We have the increased power of wealth holders. We have the increase in household liabilities. To start, and I want to go through this a little fast, but I'm going to ask you to bear with me here. Make sure I can see this. So I think everyone has, if you've read about the financial crisis, you've read about especially the build-up of the financial crisis, you've heard a lot about how profits in the financial sector have dominated overall profits in the economy. And here you can see, is this going to be red enough to show up there? I might not be able to convey it with the red light here, but as you can see, the top line is the financial profits, the bottom line is non-financial profits. Profits in our economy are largely going to the financial sector. This is an incredibly new phenomena that dates starting to the 1980s and really accelerates in the 1990s when deregulation really hits its second clip. Things like rolling back a lot of derivative, not extending regulation in the derivative sector, dismantling Glass-Steagall, and so on and so forth. I think people get a sense of how that works. I think what is often missing in these conversations is the growth of the financial industry within the economy as a whole. So this graph's a little complicated, but this is non-financial companies. And this is the growth of how much of their income comes from things we associate with financial incomes. Dividend, income off capital gains, income off dividends, income off money lending, income off things that are financial activities opposed to real economy activities. And as you can see, that also changes very dramatically starting in the 80s and through the 90s. The best way to conceptualize this is to think about how GE, especially in the 90s and 2000s, was really making most of its money off GE Capital, which was very involved with subprime lending and mortgage securitization. They still sold light bulbs, they still sold refrigeration and all that stuff, and still bought cable networks and whatnot. But when it came to their actual profits, they were a subprime lender. And you can think of things like auto companies primarily switching a lot of their business models towards lending. And so that's a really conceptual change in the way the real economy works. And as Lisa can tell you, when it came time to try to reform the financial sector after the crisis, one of the biggest opponents about derivatives weren't just hedge funds or weren't just AIG. It was people like GE or Ford or the real economy, what we normally associate with things that aren't derivatives. They show up and say, hey, you're going to mess with our businesses too if you go after this stuff. Shareholder revolution, I think, kind of a sense of what that means, but this is from forthcoming research from the Roosevelt Institute. It's going to be hard to see this, but what this is a graph going back to the 1950s, and it says, let's look at corporations, non-financial corporations, and say if they borrow $100, where does that $100 go? And here you can see up until the 1980s, if a corporation on average borrowed $100, 50 of it would go into investments. That's real investments, that's hiring people to do stuff, that's innovation, it includes innovation and R&D development. After the 80s, that drops. Where does it go instead? What you then see starting in the 80s, and this is very noisy because it's very business cycle dependent. It's an obvious upward trend. It goes towards dividends and share buybacks. So once we had a real economy that would borrow money to innovate and build and expand, we now have a real economy that borrows to pay out shareholders. When you look at the field as a whole, and this is also from that research, the blue line is corporate profits going back several decades. The dark red line is how much money is going to shareholders through dividends and net share buybacks. And there's this kind of, it's this right-wing idea that during the 2000s, homeowners would cash out their homes and they'd spend it on whatever they wanted. And they were irresponsible with their one responsibility to be a solvent homeowner. But if you actually look at elites, what they were doing with our real economy was the exact same thing. That red line at the very end of being so far above the blue line, they are paying out twice as much as that they are earning in profits to shareholders. It's money that's not going to innovation. It's not going to wages. It's not going to the things that we really want our economy to be accomplishing. Increased power of wealth holders. Who've read Tomas Piketty's book, The R greater than G thing, where the wealth of the past tends to dominate and suffocate the income of the present. We can think of a bunch of little things that all, things like changes in the bankruptcy law, the 2005 Bankruptcy Act that made it a lot harder for homeowners to discharge debt, or the lack of ability for underwater homeowners to seek relief in bankruptcy courts during the financial crisis. Changes to the tax code, the decrease in the inheritance taxes or the decrease in capital gains taxes, the way municipalities are getting, and we're going to hear a lot about that today, about how they're getting kicked around by the financial sector with predatory debts or debts that are like little time bombs designed to explode. Things like monetary policy being much more focused on low inflation instead of full employment. These are all a bunch of individual things that are all done by different actors in the economy, but when you add them all up, you see the labor share of income plummeting. And again, that's a very new phenomenon. It doesn't exist before the 80s. It doesn't even really exist till the 90s and 2000s. And if people like Tomas Piketty are right, in his new book, Capital in the 21st Century, that will continue to plummet over the next couple decades. And last thing, I think a lot of people, if you work in consumer finance or you work with communities, the ratio of household debts, credit cards, medical debts, housing debts, student loans. That's definitely gone up. One thing that, there was a brief, another thing that's related to that is something we're going to call acidification, because we're trying very hard to think of a better term, and if anyone has one, that's great. In the introduction, we talked a little bit about Polanyi's fictitious commodities, things that are treated as commodities, though they're not. They're human beings, they're land, they're money. There's things about financialization that cause us to think of ourselves and our communities not as things that are in the community or things that are part of our lives, but instead of assets to be bought and sold and traded and borrowed against or become liabilities. The classic one is we no longer think of public education as this public good that goes to the betterment of our whole society. We think of it as a contingent investment in human capital that you should borrow aggressively against in terms of student debt. We think of healthcare and things like savings accounts. We think in terms of 401ks instead of Social Security. We think in terms of discrete assets, and that's going to come up with community finance as well, where things are not part of the community towards a better municipality sector. There are things that can be sliced and diced and financialized or sold off to hedge funds. So those are the four together. We drew it as a Venn diagram because when you split them out, you can start to see how different things that concern us about the way the economy has been evolving are essentially intersections of these trends in our economy. So we can think of student loans and for-profit colleges as these kinds of highly financialized environments where people have their human capital assets that they're trading like they're a hedge fund. But also, wait, I think there's one error there. But private equity and CO pay as a result of the shareholder revolution in the financial industry. And so when we go forward today, I kind of want you to think, when we talk about things, about the way these trends, which have a really new phenomena that only go back about 30 or 40 years, how they intersect in ways that make real challenges for the broad-based prosperity we want in this country. Thank you.
Thanks very much, Mike. I think the cheerful side of the overlapping of those bubbles, honestly, is that it means that there are so many ways in and so many levers for getting at these problems too. So I want us to think of those circles as an opportunity, not just a problem. So now we wanted to turn to Maurice and Saqib in turn to talk a little more deeply about some of the pieces of this puzzle and what it really means in communities and what the impact is. If you would start, Maurice, on the housing market and
Sure.
securitization and predatory lending.
Sure. So again, I'm Maurice. I'll say a little bit about the organization that I work for, ACE, or the Alliance of Californians for Community Empowerment. So we are a California statewide grassroots organization. We have between 7,500 and 8,000 members, and we're multi-issue focused. For the past 4 years or so, one of those major issues has been housing. With the peak of the foreclosure crisis and the housing crisis, we have been working on beating back foreclosures in some of the inner cities that we're based, and also thinking of innovative strategies to go on offense, so we're not just playing defense of this crisis that's coming in. So a lot of that is moving folks on the ground. So I very much appreciate my colleagues who are up here with me who can back up some of the numbers and the research that I'm not as well versed in. But I'll talk a little bit about financialization in the housing market and how that affects our folks on the ground concretely. So if you go back to a time that was where the housing market was way, way simpler than it is now. So it used to be, if you were a mortgage holder, you had a relationship with your lender. And it was just as simple as that. Some of the financialization things that Mike just talked about muddied the water on that a great deal. So we talk to our folks on the ground. The most common thing that we hear is, I'm not sure who owns my house. And that's because when mortgages are packaged into securities, it's a range of folks, a range of investors that own the house, and it can change at any given moment. So this is obviously unsettling for the homeowner themselves, and also because they're traded on the stock market, it's subject to a volatility that didn't exist before. And as we saw in the housing crisis, when that volatility, when the bubble bursts, it means very, very bad news for homeowners across the state and across the country. Millions of folks foreclosed on and lost their homes. So when you think about it, it's actually amazing that the system worked as long as it did. But when that bubble burst did happen, we saw record foreclosures like we've never seen before, displacement of folks, specifically communities of color, an immense loss of wealth, and millions of homes underwater, millions still underwater. So the underwater crisis is something that even as the housing market shifts, and we're not seeing as many foreclosures as we did in 2007, 2008, although there are still a significant number. The underwater crisis continues and has a whole host of problems. Since these mortgages are packaged and traded by investors, there are rules about how the investor is allowed to interact with the homeowner. And one of the main ones is that they're not allowed to give principal reduction to homeowners, or they're allowed to say no way more readily than a bank can. So without this principal reduction, this return of a home's value to its market value, to what it's actually worth, there's an immense loss of wealth, and the homeowner is always on the brink of foreclosure. So I would point out that this is a particular issue in communities of color because the focus of this was on the growth of these securities and not on what's best for the homeowners. It led banks and lending institutions to issue subprime loans at rates in communities of color that were nearly double the rates for other communities. So this is, we think of this at ACE as a specific racial issue as well as an economic issue for the country. So we'll get into a little bit of some of the very exciting and innovative solutions that we're coming up with and working with partners around the country on in the next section. I will add one more thing about sort of how the securitization is playing out sort of in the next wave. since a lot of homes have been foreclosed on and are abandoned, we're seeing investors who are very smart coming in and buying up pools of vacant or foreclosed homes in neighborhoods way faster than potential single-family homeowners are able to get their hands on them. And speculating on these properties, holding on to them, presents a range of issues. One is the uncertainty of what will happen when the speculators decide to sell off all of the homes. And two, which is a very real thing in lots of our cities, is a lot of these units are being converted into rental units and then rented out at a much higher rate than existed in the past, which we see as creating an entire rental society and destroying sort of the homeowner base that we had in the past. And we know that homeownership is one of the main ways that folks, especially folks of color, are able to build family and household wealth. So I will pause there and can't wait to tell you about the exciting things coming forward.
Thanks. Saki, do you want to talk about municipal finance?
Sure. Thanks again for having me here. I'm Saki Abachi. As Anna mentioned, I've been doing the fellowship at the Nathan Cummings Foundation over the past year, focused on two main areas. One is figuring out solutions around fixing some problems and inefficiencies in the municipal finance system, and the second, doing some work around housing, working closely with ACE and other groups on that. And I'm excited to sort of be in a couple of weeks starting at the Roosevelt Institute over there. So I want to talk a little bit about how financialization has had an impact on municipal finance and student debt. I mean, I think Mike's presentation was very helpful. When I think about it, the way I sort of sum up financialization is that the theory behind it is that you want to make money off of money from people who have money, right? It's you want to figure out, you don't need to engage the real economy. You can make money just by moving money around. And so if that's the basic idea, in that kind of a system, the more money you have to play with, the more money you can make. And so the goal becomes figuring out how you can extract as much revenue as possible from every interaction you have with your customers. And so the problem with that is that if that's the case, if you're not actually producing anything new of value, then it's a zero-sum game with your customers. And the customers are us, right? It's communities, it's cities, it's families, it's students, it's homeowners. And so in all of these things, Wall Street's main goal is to figure out how to extract as much money as possible, because that's how they can maximize their bonus checks at the end of the day. But the thing is that because it doesn't actually produce anything of value, what it means is that any money that they're taking from us is money that we don't have to spend. And it's money that we, as homeowners, or as homeowners, if they're spending too much of their money on their mortgages, they can't pay the bills. If students are borrowing, or if families are borrowing to send their kids to college, that's money that they can't spend on otherwise, stimulating the economy. Cities and states, if they are forced to spend more and more money paying down finances, they are not able to provide adequate services. And so you have things like cities like Detroit that are literally forced to turn off the water on a large number of residents, but yet they're forced to pay millions, send millions to Wall Street every year because those things are off the table, as Mike mentioned, particularly in the context of bankruptcy. After bankruptcy reform, the laws were changed so that the most senior debt of all is your for municipalities is your derivatives. So before you pay, before you make sure that you're paying for services, before you pay wages to workers, anything else, you have to make sure that you're paying the banks on the derivative deals that you have with them. And so the thing is, this has become a problem because over the past 30 to 40 years, debt has really replaced income in our society. Right? The fact is that since the mid-1970s, since you had a huge rollback in labor laws, workers' wages have stagnated in real wages, and they've been forced to take up more and more debt to make ends meet. You've had credit card debt now tops $1 trillion. Consumer debt has skyrocketed over the course of the last 30 years. With student debt, we've had, Anna mentioned, student debt is now above, I think it's $1.2 to $1.3 trillion. There are 40 million people that are paying it off. And the thing about student debt is it's actually not debt that's paid by students. Student debt is actually, students don't pay student debt. graduates pay student debt, parents pay student debt, grandparents pay student debt. So this is actually debt that really haunts people for life. In fact, there's an alarming number of people, stories that are coming out, I believe it's hundreds of thousands, who are now having their Social Security checks garnished to pay student debt, right? So it's actually become a really big problem, and like when you look forward, like in terms of the impact that actually has on people who are starting their lives, trying to figure out what are they going to do in the worst job market that exists in decades, now having to take on record levels of debt. It really sort of has a huge impact, not just on what type of job you try to find, but also just other decisions about how to run your life. And then the other thing, of course, is municipal debt, which has also skyrocketed since 1980. In 1980, total outstanding municipal bond debt was roughly $400 billion. Now it's closer to $4 trillion. Right? It's grown nearly tenfold in the last 35 years, which is insane. And the thing is that as this has happened, Wall Street has really adjusted its business model to make sure that it can actually make sure there's as many opportunities as possible for more and more transactions so that they can maximize their revenues from it. And so, Maurice mentioned that with homeowners and with mortgages, often you had banks that really targeted particularly communities of color with predatory products. The fact is that the same stuff actually happens with cash-strapped cities and states. They're targeted with predatory loans that have hidden costs, hidden risks that are designed to fail at the end of the day because the banks actually get their money up front from the fees that they charge, and they don't actually care if the loans work out well or if the other deals work out well. And in the long run, the thing that's really particularly nefarious about this is that just like predatory mortgages were heavily targeted communities of color, the fact is that the impact of all of the problems of municipal finance are also borne most heavily by communities of color or cities with large populations of communities of color, like Detroit, where the bankruptcy that Detroit is facing, it has many causes, but one very big one that's been unspoken in a lot of cases until this report that Dean was put out last fall really is the financial deals that drove the city there. And so, I think as we start thinking about this, the key thing that's really important is that financialization sort of has its, it can seem hard to wrap your head around, but what's easier to wrap your head around is sort of the impact that it has, because the impact is really, there's a human toll that's felt by people across the country. And so again, in the next section, we'll sort of talk about more Anna, promise it would be hopeful and innovative. I think that's sort of the next section. Yeah, we'll cheer you up.
Yeah, just again to tie those pieces together a little, it can almost sound like a conspiracy theory, except it happens to be, it's a true conspiracy theory that there are in both the housing and the municipal finance example is really striking incidences of a product or a structure that was driven by the fact that somebody at a set of banks could make a higher bonus at the end of the year by selling something. In particular, subprime mortgages, you got paid more. Lots of people in a select group of institutions made more money for making bad loans and selling them than they did for making good loans. And the result was a foreclosure crisis. Lots of people at financial institutions have made more money by selling complex and risky deals to municipalities than by selling simpler and more predictable ones. And we have a municipal debt crisis. The good news, on the other hand, is that it should not be impossible to say no to those things. And it shouldn't have been impossible the last time, and we should be able to build the rules on structure and accountability that does say no the next time. So we wanted to pause here and open the floor for some questions and discussion on this section. And then we'll turn to the solutions and campaigns.
It's for the live stream.
Well, I mean, I think it affects it enormously. Just to inject one sort of moment of data that I've just been looking at because I've been editing a report on this. In the last 5 quarters, so in 2013 through the first quarter of 2014, between campaign contributions and lobbying expenses, and the lobbying expenses are actually larger than the campaign contributions, the financial sector has spent some $725 million on projects, and that's just what they actually have to report. It's much more than that that's hidden, so that's just the tip of the iceberg. But it is the single largest iceberg in terms of sectors, and it affects. And I'll let others talk, but it affects every piece of the decision-making process on this profoundly. Who wants to start with what?
I mean, so one thing that I should mention, just the story that comes to mind, is in 2009, shortly after the financial crisis, there was a lot of energy and it seemed like it was going to be quite possible to actually roll back one of the really bad provisions of bankruptcy reform that made it impossible to write down your mortgage debt in the context of bankruptcy. And where it seemed like there was momentum to actually pass a law that would allow judges to actually write down mortgages. And it completely died. And back then, Dick Durbin had a great quote, which was, "The banks, frankly, they own this place," right? And I mean, I think that that's just a reality of it. That like you have I think to me that quote sort of summed it up.
I would say even in specific states, in California in 2010, we did a lot of organizing on the ground to pass a homeowner bill of rights, which put some protections in for homeowners against unjust foreclosures. We had actually tried it the previous 2 years, and it was like a madhouse. I mean, the banks had record lobbying amounts in each of those 2 years trying to kill that legislation. Luckily, in 2010, our organizing was stronger. But yeah.
I think another thing you see is there are specific instances of banks basically writing legislation for Congress to pass because they give them money, and Lisa can probably give you very specific examples of this. But I think the money also is very important in setting the limits of the discourse. So in our next panel, we're going to talk about some ideas that we will probably not think are crazy ideas, though if you go to people who have their hand in the honey pot, would say, you can't do that, you can't talk like that, you can't give everyone a postal banking account. That would be crazy, though it's obviously a very simple solution. So I think both the actual, we're giving you money to do this, quid pro quo, but also we're giving you the money, these ideas are crazy, is also a very powerful thing we have to push against. It's difficult.
Yeah, I think you watch the impact play out in the fact that the industry argument always gets a hearing, even if it's a lie. In the fact that the assumption is that we have to say yes sometimes, even if they're wrong all the time. We can't always say no. In the assumption that anytime people aren't watching, the fallback vote is the one that industry wants. And the assumption that to the extent that something becomes a public debate, there will be enormously more resources on one side to shape the debate. We see it in the ability to influence regulation just by overwhelming argument hours, like lawyer hours spent, coupled with the threat of being able to make Congress do something, coupled with the ability to bring lawsuits if they don't like the way things work out. All of that said, that paints a somewhat hopeless picture, and it's certainly a challenging picture. And I think, it makes sense to think about how to advance arguments side by side about how we curtail Wall Street's power. Part of that is about the levers they use for that power, and part of that is about their domination of the economy. But the story of Dodd-Frank also, which is a bill that was much more modest than it could have been and should have been in many respects, but that was also much more ambitious than anything Congress had been willing to do for many, many years before that, and was opposed by every piece of the financial services industry, essentially. And a bunch of things happened anyway. So in part because there's such a deep level of understanding out of the world how serious the problems are, and such a deep level of anger, that there are certain lines that if there's a spotlight shown on what's happening and what choices are being made, there's certain lines that I think folks are, get nervous about crossing. So there's something to build on as well.
Maurice, you've already mentioned the disproportionate impact on communities of color.
Yes.
Can you say something more about the disproportionate impact on young people beyond the student loan crisis? Can you give me some articulate some specific analysis for that age group and in the near future for them?
Yeah, and I'm sure folks will have other things to add. One of them is that home ownership has just become much, much harder since the financial crisis. So I'm 27 right now. I am like maybe interested in getting a house soon. But if I would try to do that, I would have almost no chance of buying a house in California, because since the market hit bottom, investors are paying cash. They're paying well above what the asking price is. It's almost impossible for just a young person to start out to try and get their first house. So that's a really big one that we're seeing. Another is that a lot of the rental population is also sort of around my age, and rents are just skyrocketing because investors have owned so many of these properties, and are using as one of the ways to in the meantime, while they're speculating on the price of them, using one of their income streams is jacking up the rent and after they split this what used to be a single family home into 4 apartments, they jack up the rent in the neighborhood as well. So those are I would say, of the folks the younger folks that we deal with, those are 2 of the bigger ones in terms of housing financialization. I'm just laughing because that's a common question I get. I think with a lot of the solutions that we're about to talk about, I think that it's a big ship, but I think that we've got some really great solutions to turn it more quickly. And I think that 20 years from now, folks there's such an amazing awakening going on right now, which gives me a lot of hope about sort of the ship turning for young folks my age and younger.
There's one thing I would say this is connected to, but not exactly the same as the student loan question, is that one of the big things that ends up happening is because states are spending a lot of have huge budget problems really at the end of the day. They're cutting funding for state universities in many cases, and so state universities are then forced to do a number of things. What that includes is taking up more financial deals to make ends meet. But one of the other things is that because out-of-state students are actually bringing more revenue than in-state solutions, you then really start trying to market to out-of-state students. So it makes it harder for in-state students to actually get into college. And then to actually attract out-of-state students, you start trying to build more facilities, more things. Some people call it the amenities arms race. And what that does is then you're actually borrowing more and more money to do big capital projects to attract out-of-state students. And there's an analysis done by the Higher Ed Not Bad campaign that just came out recently that sort of shows that increasingly large amounts of your tuition increases are actually going towards paying debt service for these big capital projects. And so what it actually ends up being is, because there's not enough revenue coming from the state, you end up at the end of the day basically putting the burden on students in the form of tuition, which then leads to hikes in student debt. So there's this huge cycle that creates, which is interesting and a problem.
Basically what they just said. One thing that's interesting is one of the allies in the campaign against student debt is the National Association of Realtors. If there's ever a comment letter for student loan related issues, there's letters from obviously community activists and so on, but realtors are jumping in and they have a lot of power, which is very happy to see them there. But it's not just like other people are starting to realize what a big generational problem this is, and it's going to impact a lot of other business interests. And it's about trying to ally those groups together and trying to make productive change, which I think there's opportunities, because problem is so big.
I was actually going to make a similar comment because I was in a meeting yesterday that the Mortgage Bankers Association called a number of community activists and housing activists together to talk about their concerns about lack of shrinking homeownership among young people. And, the challenge in that conversation with them is to push them, and people did in this conversation, to think about income and employment as reasons for that, rather than overregulation, which is their default, right? They go to it is the dynamic of the trade associations to go to the least common denominator, sort of, or the worst common denominator. But there's an opportunity because it is a serious problem from their perspective, and it feels sort of funny or ironic or strange bedfellow, but it partially reflects the fact that housing is not just something in the economy. Housing is a very large piece of the economy, and it matters to many sectors of it. And it is really an organizing opportunity and challenge to get some more of those folks to coalesce around a more positive, rather than just their first impulse vision of what can be done.
Karen's question led to a new question I have. What about the senior community who do not have the time that the younger generation might to recover and regroup? What are your thoughts about that?
As part of a broader phenomenon of financialization, I think seniors going forward, we're going to see a lot more income insecurity in old age because of the transition to a very financialized form of retirement security through 401ks, high fees, and so on and so forth. I think student debt's obviously also a problem for co-signers, people who are in old age. You often have tons of stories about it was already brought up. I think those things are particularly jump out. I think also to the extent that seniors and other people I think should actually follow stuff up, rely on municipal services, perhaps public transportation, parks, Medicare, of course, libraries. To the extent that that is dismantled and slowly kind of, put up as collateral for debt servicing, I think that's going to be a big problem. That's going to be hard to see, but be very relevant in people's everyday life.
One very, very active debate underway right now is around sort of another example of financialization. Right now, some people who advise you on your retirement actually owe you a fiduciary duty to put your interest first. Another set of the community of people who could, put themselves up as advisors don't owe you that fiduciary duty. Gretchen Morgenson talked about this, yes, and part of the reason people are talking about it is because the Department of Labor right now is trying to write a rule that would close some of those gaps with regard to retirement security accounts. The SEC was instructed in Dodd-Frank to take a look at those gaps with regard to other retirement accounts. The Department of Labor wants to write a rule, and the investment industry is up in arms about it. They are blanketing the world with the argument that this will make it impossible to give people investment advice. And they have to date succeeded in getting the Department of Labor to withdraw its first rule, delay a second proposal for an extended period, get all kinds of folks on the Hill to write letters saying this would be a terrible idea. So a colleague at a conversation the other idea very aptly said, the financial crisis was a tornado in terms of loss of wealth for seniors, whether that wealth was in their homes or in a stock portfolio. But these investment fees are like a termite that gets you, leaves you in the same place, but you don't see it crumbling away over time. So.
I asked one of my bankers to give me a fee breakdown from a very small account I have with a large bank that I'm thinking of pulling my funds out of. He has yet to answer that, but I could track what, I said, why isn't it growing the way my other investments are, which are basically in the same, types of things? And the answer is because I'm paying the bank probably all my profits.
Yeah. No, so I feel like we should move to the next piece of the conversation and can come back to these questions as well. So here's our what do we do about it piece. And I think the conversation thus far has underlined the fact that the problems are tremendous, that our opponents are immensely powerful, but I think it really is also true that there are huge opportunities to make change. That's partially because there is such wide agreement that we need change here. And as I said before, sort of abiding anger at Wall Street. I wanted to read you one piece of polling data just to sort of fill that in a little bit. We asked, this is almost a year old, there'll be new data soon. Should Wall Street financial companies be held accountable with tougher rules and enforcement for the practices that caused the financial crisis, or have their practices changed enough that they don't need further regulation? Only 9% of people said they don't need further regulation. 83% of people said that they needed further, and that includes 82% of independents and 75% of Republicans. This is not a partisan issue. And when you sort of do a head-to-head, I won't bore you by reading the language, but when you do a head-to-head test and sort of put up the argument against it, which is overregulation stifles innovation and is killing the economy and too much government is the problem, the argument that Wall Street needs regulation and Wall Street needs to change still wins up against that argument. And that's just a very powerful force that we have on our side, and so part of all of our job is to figure out how to mobilize that and make that matter, bring it to bear where it counts. The other thing is that there are lots of paths forward towards these changes that are available to us. It's one part of the advantage of there not having been enough work on this in the past. There's still a bunch of low-hanging fruit out there, but there's also a lot of things that regulators can do without any legislative change. So there is tremendous potential for change that doesn't stop at the Congress won't ever do anything, so we're done. There's important things that we would need Congress to do, but there is a lot that could be done at the federal level without Congress if we figure out how to change the conversation. And then there's a lot that can be done locally and in the states, and lots of good organizing campaign potential, and lots of good opportunities for coalition building and for putting together unusual allies. None of those come easy. The notice that we have shared interest is relatively easy. Actually building it into a mobilizable force runs up against a bunch of real barriers, but that too, I think, creates huge opportunities here. So I wanted to start by asking Mike to just, and I might, poke you after a little while to keep this piece short, to talk about a couple of federal opportunities or things that you see as particularly important. And then maybe I'll add a couple more and then turn to Saqib and Maurice to talk about local organizing campaigns.
Yeah, I'm going to keep this pretty short just because I think that the real interesting stuff here is in the organizing, particularly at the state and local levels. But I think there's a couple I think one way to understand Dodd-Frank is imagining porting the New Deal regulation that came to define the commercial banking sector into the financial markets. So much of our banking has moved from those commercial banks to capital markets, to international capital markets, and firms are not strictly regulated as banks, and the activities that are bank-like also did not have a banking regulatory regime. So what I mean by that, I mean things like, you had the Exchange Act. I'm trying to remember all the alphabet soup of the New Deal. Don't tell my bosses. The Exchange Act, which is focused on equities and making sure there's price transparency and basically using the disinfectant of information and sunlight, porting that into the derivatives market. You have a very similar mechanism. Derivatives will now increasingly trade on exchanges. There'll be price transparency. The market can discipline itself. The SEC having to disclose complex financial instruments, I think that is an analog to the CFPB. Consumers now see a lot of very complex financial instruments. They need a person who's on their side forcing disclosure and enforcement. The FDIC commercial bank has now been extended to Wall Street banks. Barney Frank would say there's now death panels for places like AIG or Lehman Brothers. I think those conceptual ideas of enforcement, transparency, price discovery, and then special targeted government action are in place. a good question whether or not it will grow to do what it needs to do. We're already seeing a lot of interesting things, though. For instance, now the SEC can look at private equity markets. They've already gone and got a report saying, hey, look, there's... Oh, I'm sorry. I'll actually just get very close to it. The SEC is now, looking into the private equity markets, which before was distinctly cleaved off from, formal regulations, and they're finding all kinds of abuses. And hopefully that will push back on a lot of the stuff we see in financialization, the kind of siphoning of profits off to finance, a lot of dubious kinds of value exchanges. The other thing I really like to emphasize is we need to think a little bit more consciously and vocally about public options in finance. I think, we talk about how can we get underbanked and unbanked communities better financial services. The post office just put out a big report earlier this year about postal banking. Why doesn't the post office give people a small checking account? Senator Warren endorsed it and brought it up in a couple of very influential places, which was really great. But it's such a conceptually useful idea to think, we can do these series of carrots and sticks with private industry that always don't work and always sometimes leave consumers even more exposed than they were before. Or we can just do things ourselves. We actually have we make sure that people who receive Social Security have a debit card that is distinctly fraud and predatory free. We could extend that to everyone. We also see it in housing markets. Right now the government is the lender in the housing market, and it's doing a pretty good job of it. Certainly compared to the parasitic kind of cesspool of the PLS market as we saw during the housing bubble. So why don't we have a bigger footprint for the government in housing lending? I think those are ways of doing regulation. We know this concept from healthcare, but it's relevant for finance as well. We want to ensure a baseline that is not predatory. We want to ensure access. We want to ensure some sort of cost control. There are ways to do it ourselves, and also is relevant for 401ks as well and for retirement securities brought up. That I think is going to be one of the next conceptual changes for liberalism that I think financialization and the stuff we're doing here is very important as a spear point to go forward.
So just to fill in some more of a similar picture on the federal front, I'd say, having said that there's a lot that regulators can do without Congress doing anything more, I don't mean to say that they necessarily will do it or that the fight about those things is over. I mean to say that there's a place we can have a fight, but there are a bunch of important places where there will need to be. And among the sort of examples that strike me as the most, or just a few examples that are compelling and obvious. One is the Consumer Financial Protection Bureau, right? A huge win of Dodd-Frank that we now do have an agency devoted to consumer protection. They've kind of finished writing the rules that Congress exactly told them to do, and have now moved on to the abusive, deceptive, and unfair practices-based rulemaking in the market, which is a heavier lift, and they've been under attack from day one. They are about to be under a whole new level of attack as they use that authority to take on payday lending, and then likely a major piece, sort of corporate impunity management arbitration clauses in consumer finance contracts. So there will be huge wars ahead to create the space and do the pushing to enable those possible wins to come to fruition. Another example is the piece of Dodd-Frank that the regulators haven't yet done anything meaningful about, which is a section called 956, which says that compensation at large financial institutions can't encourage excessive risk-taking. Simple, sensible, potentially, and extremely powerful. The rules they wrote for it the first time, very weak, don't do much. There's an opportunity to demand that they write rules that really would make a difference there. They have to bite. Even bigger, Mike talked a little about the rules around resolution and the requirement that there be resolution plans for the largest institutions. Dodd-Frank lays out a process that says these large institutions have to present and engage with the regulators about a plausible resolution process. And that if there's nothing, if the process isn't plausible, the regulators actually tell them to do different, not just say, give us another plan, but you know what, there is no plan. It's plausible for an institution that looks like you, that has data view and is connected with you, as complicated with you. You need to actually change your business. That opportunity is absolutely available through the legislation. A Republican FDIC chairman in a recent interview made the argument, exactly the argument that I'm making, that authority is there. So just there too, tremendous opportunities to use the regulatory tool available to make further change, as well as, of course, a whole new set of things that would require legislation. And I think to link to the local campaign, one link between those opportunities and the local campaigns that we'll talk about now is that if we think about them right, in addition to being transformative at the local level and being models that can be replicated and so go to scale and provide examples of things that can be done at scale, those local campaigns are what help transform the conversation and the climate that in ways that make these national pieces that now are possible that seem sort of like, really? Would they really do that? Would they really get that far out in front? What makes it possible is local organizing that needs both local and national focus. So with that, I'll turn to, you want to go first, Maurice?
Sure, yeah. I would start it off to say that, our primary goals in this work, before we sort of get into the details of it, are to A, make sure that we're keeping folks in their homes throughout this underwater crisis, and B, using the strategy we know that's most effective to do that, which is principal reduction. Allowing folks to restructure their mortgage so that they're not owing more than their house is worth. Just to say another word on sort of how real the problem still is. 5 million homes lost since the foreclosure crisis. Millions more, about 10 million or so, are still deeply underwater. And just in terms of folks of color, since we have a lot of our wealth in our houses, about 66% of Latino household wealth was lost during the crisis. And for African American folks, that's between 50 and 60% of their household wealth. So it's a huge, huge issue. And there's just this continuing weight on top of folks' shoulders with the underwater crisis. So as we're looking into solutions, we're thinking, what can we do at the local level that accomplishes those goals, really wins for folks and really gets principal reductions. But we don't want a solution that only will work for one locale. So in addition to that, what is replicable in other cities across California and really across the country? So I'll sort of explain what's happening in the city of Richmond right now. As a little background on Richmond that will be helpful to how this campaign is working. Richmond is a majority-minority city. So about somewhere between 60 and 70% of the residents are people of color. It was amazingly hard hit during the foreclosure crisis. About a quarter of all the homes were lost to foreclosure during the foreclosure crisis in Richmond. In a lot of neighborhoods, upwards of 50% of the homes are still underwater. So these are folks who are still on the brink of foreclosure. And a lot of these underwater homes are private label security homes. So packaged, really complicated, invested and traded securities. Another important fact about Richmond is Richmond has spent years, really a decade, really building a progressive presence through their elected officials. So there's a great mayor in Richmond, Gail McLaughlin. If you ever have the chance to hear her speak or meet her, please do it. She's amazing. And a progressive alliance that has several members on the city council. So we can't discount how important that particular fact is to this program. So the program and the organizing strategy, it's called the Richmond Cares program. So it focuses on this pool of loans that is both underwater and the private label security loans. So the way it works is the city makes an offer to the banks who service these loans to buy them at fair market value. So let's say you owe $200,000 on your house, and your house is worth, this is not a real example, your house is worth $100,000. The city will make an offer to the bank to buy it from the bank for $100,000, for around $100,000, what the market value is on the home. The city then will take the loan, and because it's bought at market value, they can then restructure it for the homeowner and put them into a modification that works for folks so that they don't have this weight of underwater on their heads. So that is sort of the cleanest, idealist scenario. If sure. Aha.
Sorry, why would the banks agree to sell it to the city at market rate as opposed to restructuring the loan for the original buyer?
So one of the issues is because these loans are pooled into private label securities, the bank will often say, our investors, who maybe are changing right now, won't allow us to restructure the loan and give you principal reduction. So this is, and I'll also add that this first offer, Richmond made this first offer to banks, and zilch. No one took the offer. The thing, the sort of weight that lays behind it is if the banks don't sell, the city will then use the power of eminent domain to take the mortgage from the bank, the loan from the bank, and then restructure it for the homeowner, paying market value to the bank for the loan, then restructure it for the homeowner and put them into an affordable modification with principal reduction.
So this is the project that I think I read about this. Isn't this the thing that Stephen Gluckstern was doing in California?
That's right.
So it is still trying to move forward.
Yep, absolutely. So like you're saying, this is sort of getting a lot of attention with folks. Really, because this is a really exciting sort of new avenue is open. Folks thought that this group of loans was untouchable, and it really is. So many folks across the country have these private label security loans. It's really opening up lots of new possibility. Several other cities across the country are actively looking into pursuing this program in the way that the city of Richmond has, including Seattle, Minneapolis, my birthplace of Newark, New Jersey, who just elected a really progressive mayor who's pledged to keep this as one of his main core issues. So the program is still very much alive, and so that's how it works. One of the reasons that we were one of the hurdles of the program is that banks, as you might imagine, are very much against the program. And you talked about money in politics earlier. We've seen amazing amounts of lobbying and pressure from banks. Several cities have stepped forward to start to do this project, and based on the really fear that banks are able to generate in some places, they've hesitated a little bit, which is why I said it's really important to have that strong progressive presence that we have in Richmond and a number of other cities across the country. So yeah, this is a very, very exciting program, and I can't wait to answer your questions about it.
Sure. So I can talk a little bit about what we're doing on municipal finance. I mean, as I mentioned, our basic strategy around municipal finance really has been try to figure out what we can do at the local level, state and local level, just because of, as Lisa referenced, Mike mentioned, sort of inadequate action at the federal level. And so the idea is that can we actually have things happening in a lot of cities that can then create momentum for, well, both in the short term actually give us meaningful relief, but then also create the momentum for broader change at the federal level, while also creating momentum for actually solutions that bring in revenue to and help bring revenues at state and local levels as well. And so basically, in terms of if we identify the problem as with every single transaction that cities and states or school districts enter into, Wall Street figures out how to take out a bigger and bigger share in fees, then in many ways our first solution really is how do you actually eliminate possibilities for that to happen, which is And so, we have a three-pronged strategy we've arrived at. So prong number one is creating more public options that basically altogether avoid the opportunity for that interaction to take place. And so some of the ideas along this lines really are establishing public banks. And so a couple of years ago, there was, 2010, 2011, there was some momentum around public banks at the state level. There were bills that made it through, in some cases, I think it actually made it through one house in Oregon. Hawaii came close to passing it. Massachusetts passed a bill to study it. And there are a dozen other places that had bills that made it through various places, through various things short of actually passing anything. But so now there's actually an interest around trying to see if we can pass banks at the city level. And so one of the places where there's the most traction on this is in San Francisco, where city county supervisor John Avalos has been working closely with this person, Carl Vitale, who's really sort of studied it very closely and is actually coming forth with a proposal for how to actually get it done. And the thing that's really exciting about it is that it is possible to do it, and it's possible to do it particularly in cities that have strong home rule provisions. And sort of the legal theory will vary from state to state, but there's, we had a meeting that we put together a couple of weeks ago where we brought together elected officials from 7 cities, as well as organizers and academics to discuss various ideas around these. And public banks are one of the big things that we discussed, and there's a lot of, amongst the folks that were in the room, a lot of energy excitement around that. So I think that's one thing that we can actually, hopefully we'll expect to see something happen going forward on it relatively soon. The other thing we're trying to figure out on that, and it seems like there are possibilities with it, is if you can have, figure out a way to set it up so you can have different cities contributing or basically partnering on doing these types of things. And so is it possible to set up a regional bank or a bank that maybe San Francisco sets up, but then other cities can also opt into? And so, those are things that are interesting, exciting, and really gets us towards really try to imagine what are alternatives around banking that both will allow us to look at consumer banking issues as well as municipal banking and try to really figure out how you bring those things in-house. One of the other things is on this idea of creating public options is insourcing financial services. There are many things, for instance, investment management, pension fund management, for which cities and states or pension funds end up paying millions in fees, but that where if they actually were to just bring a lot of stuff in-house, they could actually save a lot of money. And basically the evidence thus far shows that they actually wouldn't have any worse returns. And so there's actually interest, quite a bit of interest in New York around figuring out if you can actually have at least some greater portion of the pension fund management insourced, for instance. The other thing is there are some things where it wouldn't necessarily make sense for any one city to do it itself, but maybe you can have cities pull together and do them together. So for instance, bond underwriting. Issuing bonds, well, no one city necessarily issues enough bonds that it makes sense for them to have their own like an in-house underwriter. But if you actually had cities sort of in a region sort of pulled together, they could potentially figure out how to do their own, provide other debt management services themselves, which could be a great way to sort of cut Wall Street out altogether. And so the second piece of this is if you can't create public option, the second prong of the strategy is, well, how do you collectively pull together the power of different cities to try to renegotiate fees at a fundamental level? And so the idea here is that there are many fees that are sort of taken for granted and sort of seen as, well, this is the market rate. The market rate, for instance, for private equity investments is called 2-1-20. You pay the banks or the private equity firms 2% upfront of the total amount that they're investing, and 20% of the profit also goes to them. And so that actually ends up being a lot of money. But there's no reason why it's 2-20 and not 1-5, right? There's actually zero reason. But if you try to go to any pension fund and say, we should pay 1-5, they'd say, we can't, because no one will go for it. But the fact is that actually you can if you actually use your power as, if you sort of draw the line and say, well, this is what we're going to pay, and if you don't want the business, hit the road. And if you have enough cities doing that together, you can actually move the market on this. And so in a lot of cases with fees, the way the cities and states approach the role is they think that they're sort of market takers and not market setters. And we need them to start really changing their role. I mean, an example of this is Stanford University no longer pays 220 on their endowment because they said that we're not going to pay that. And so I think they actually pay like 1 in 10, right? The fees are completely arbitrary. There's lots of things for which the price actually there is no relationship to the cost of the service. And so there's room to maneuver around that. So there's a big campaign going on around that right now in LA, where in the city of LA, you have there's a number of public sector unions that are having the contract up for negotiation. And so there's a big community labor campaign that's come together around that, which ACE is a part of. SEIU, APSME, a number of unions are part of it. And they put out a report a couple of months ago that showed that the city of LA paid, well, at the time, the number was $200 million in fees last year alone, publicly disclosed fees for financial services, which was more than the street services budget. Since then, they found another $100 million in fees. So now it's $300 million. Million. So now it's up to $300 million, which is double the streets budget. And so one of the big campaign demands that they're making at the bargaining table is that as part of bargaining, the unions are proposing that the city needs to really try to lower these fees and badge other cities to do that. Finally, the last piece of this, the third prong of the strategy is, again, first, create public options. If you can't create public options, then collective action to reduce fees. Third prong is, if you look at the deals you already have and try to figure out how to fix those. So either renegotiate bad deals that already exist, or prosecuting fraud and litigating fraud to actually recoup money where there's been outright fraud or illegal behavior. So a couple examples of this. One, in Detroit, we actually had, in the context of the bankruptcy, we actually had a pretty big victory last summer, the spring, which is there's a series of interest rate swaps that the city had entered into back in 05 and 06 that really blew up, and now the city owed about $350 million in termination fees on these swaps. And because of the bankruptcy reform, the swaps would get paid out before anything else would. And so the banks are trying to cut in front of everyone else and say, you got to pay us before you pay anyone else. And so they agreed to sweeten the pot by cutting the $350 million down to about $250, and said that if you pay us right now, we'll leave. And so there was a lot of organizing that went around that. There was, so Demos put out a report that really showed the role that the swaps actually played in contributing to the bankruptcy, and really made the strong case as to why these deals were probably illegal in the first place. And there was a lot of organizing at the local level with community groups and with labor unions on the ground there. And as part of the campaign, basically, we're able to, as a result of that, initially get the judge to reject the settlement and say it's too high. The banks need to get something lower. They came back. The judge rejected it again, said it's still too high. In the end, the city ended up paying only $85 million. So they actually, whereas last summer they would pay $350 million. So basically, they were able to save $265 million as a result of this sort of back and forth on this. So what we've seen is where you actually, when you actually have, if you actually have some legal leverage around this and run a campaign well around it, you actually can cancel some of these deals. And using the threat of litigation to actually recoup past losses is a key strategy in being able to do that.
Thanks. So just to go back a moment to the sort of public option theme, Mike mentioned postal banking, which there's increased conversation on, and we should leave it on the table for questions. Saqib talked about public banks, which obviously matter beyond at the state or the city level. They're important for municipal finance, but for purposes well beyond that as well. I think people have been excited about these campaigns because a public bank has the potential to generate revenue for the state, to lower debt costs for local government, and to strengthen local banks, and so enhance lending to local businesses and have banks actually sort of do the job they're meant to. I mean, the evidence is that in North Dakota, the example of there being a public bank, there was much less withdrawal of credit during and after the crisis than anywhere else, because there was an institution invested in local community banks and invested in the local economy. And so people are looking for ways to replicate that or replicate pieces of it, or build on pieces of it, I should say, pretty clearly. It would look different in any state other than North Dakota. But the other thing that in a conversation that many of us had about some of these issues recently. People talked about some in the kind of public option space, is thinking more about what credit unions are and what they could be. Half of Americans already do some banking at a credit union. It's sort of remarkable fact. But many credit unions are not very different from banks. More of them could be some of them are extremely different. And really, there is an infrastructure there which could play a role of being community-controlled capital in a different way. What would it look like to have that be different? So I think Maurice might want to add something quickly on, just to put it on the table to get the conversation before we turn it to questions on alternatives in the student debt world, or ways of thinking differently about education financing to feed into the conversation, and then we'll just sort of tease on it, and then we'll.
Yeah, I'll just really quickly add. So one, I think the most exciting thing is an emerging coalition called Higher Ed Not Debt, which is a range of folks from around the country who are really taking on the issue of student loan debt using 4 main umbrellas. One is state funding. So as our municipalities and states are strapped, as Sakib was talking about, they're sort of reducing funding to schools that are in their states, which is making students have to take on more and more debt. And the money that the schools do have, they're using it for this arms race to build all sorts of things to attract out-of-state students. So students are paying more and more. So one umbrella is looking at how do we look at the state funding and doing it in a way that really is serving current students and making sure that when students graduate, they're not burdened with unfair debt. Another area is refinancing student loans. So Elizabeth Warren just had a bill that unfortunately died in the Senate around making sure that we can provide students the opportunity to refinance their student loans in the same way that you could refinance your car loans or any other loans that you have. It's very difficult to do now, so that's another umbrella of work. A third is reforming how servicers are working with students. So there's just so many stories of both servicer fraud, servicer abuse, servicers who are way more clearly focused on the profit of the banks that they work for instead of working with students to figure out other payment plans, et cetera. So looking at servicer reform, and then finally, a large force driving this entire conversation is the increase in for-profit education and what that does to our local schools and what that does to the students that go to them as well. So looking at just greater accountability around those for-profit schools, and how do we organize students who are at for-profit schools currently. So like was said, it's kind of just a teaser, but those are sort of 4 main umbrellas.
Yeah, I mean, I think that's perfect. I think, the servicer stuff in particular is relevant for other things because we see the same issues we've seen in the housing market show right back up. And so it's not particularly surprising. And there, in particular, the government has such a big footprint, especially after a healthcare reform, that it can force a lot of changes just by who it's doing business with. So it's very helpful to push in that direction. There's a term called, I'm trying to remember the name of the academic who used it, called the Brazil effect in higher education. He is referring to developing countries that are developing very quickly, like Brazil, where the demand for higher education is outstrapping the public's ability to provide it. And so what you see is a lot of kind of predatory for-profit schools filling in those gaps. And particularly a lot of these countries are, you see it in Eastern Bloc nations as well. They're trying to use a lot of like tax incentive and public money to kind of build up institutional capacity outside the public sector. And it's just basically going straight into private hands and for-profit companies. And you can imagine that happening, right? What he also argues the United States is having this in reverse, where as the public sector stagnates and is dismantled or is replaced or is just not meeting the increased demand, for-profits are filling in that gap as well. And the results are predictable. It's bad services that are cost too much, leave people in debt, and give money to people who shouldn't get it in these situations. And so when we think of public, obviously the tuition has the most bite, but things like out-of-state students is part of a bigger picture. Things where the kind of tripartite systems don't have the internal mobility that they once had, are just as relevant for providing this public institution that I think really is not going to become any less relevant in the future.
Great, thanks. Let's open the floor for questions.
Sure, I can start with that. I mean, one main thing, I think Sakib may have mentioned this in the first section, is that all of these issues are part of a coordinated strategy that really are disproportionately targeting communities of color. So it's, it's one important message frame is it's not a coincidence that this predatory municipal lending, predatory household lending, high rates of student debt are all happening in the same places, and that those places are communities which have a high percentage of low income and folks of color. And we should sort of stop thinking about those as just like 3 different buckets, but part of a coordinated strategy that really a very few number of people are coordinating and targeting folks. So that's what I'd say. Did you guys add stuff?
In terms of messaging, particularly at the federal level, I think we passed out a copy of our report, Unfinished Mission. If you don't have one, ask for one. We did it with AFR. Brad Miller here was a contributor chapter. And we wanted to basically focus on the idea that there were immediate problems in the financial crisis, and Dodd-Frank did or did not address a lot of them. But the more general issue of how we build an economy and what the kind of role the financial sector we want to have in it is an unfinished mission. It's still something that needs to be sorted out. So some of it's general ideas that are relevant. Some of it coincides with, what kind of businesses do we want finance to get into? And there's been a big thing where they've been moving aggressively into the commodities market and affecting the price of aluminum and tin, which in turn affects the real economy in very direct ways. And that's stuff we don't associate with that with the panic of 2008 or the housing bubble, but it's no less relevant for how the economy works for all. So trying to understand and put an agenda forward about what are the things that the financial crisis exposed, but it still will be ongoing in the future.
One thing I'd say on this is that in some ways, messaging is the big picture is the least of our troubles. Some part of the message around fighting to change Wall Street is like falling off a log. At each subsidiary level, that's not quite true. But I think the deeper questions are about how we think most effectively about strategy and about what the opportunities are to work together to make progress on them. And then, of course, there are always questions about message, but I don't think it's the first question in a way here.
I think one thing I'll add is I think one of the unifying themes across, as Maurice sort of talked about, sort of the problem end of it, right? That it's sort of some unifying themes across, and I think there's also a unifying theme across some of the solutions we're trying to push, which is the idea of community control and actually having more control by the people who actually are by communities, right? And so, which is community control. And so, but yeah, so I know with the housing work, we are sort of talking about, local principal reduction is sort of a way of having community control over our mortgages. There are strategies around having community control over vacant properties. A lot of what we're talking about with public options and municipal finance really is about having community control over how our cities are financed. Things like paid forward for student debt really does sort of get to having more community control over how education is financed. So I think that is sort of one of the things that's a unifying theme that, certainly can translate into a message.
One other thing I'd say is I think the challenge, having said that, campaigning against Wall Street is like falling off a log. Breaking through people's sense that this is too complicated for them to understand, that it's not clear what the connections are, or that it's too hard to affect. Those, I think, are the sort of campaigning and messaging challenges that we need to think about.
Lisa, I wanted to follow up on your comment about strategy. To ask you all to go deeper, what we've heard today has been some mix of municipal, a little bit of state, and then some federal opportunities. As you think about building a long-term political campaign, how do you think about sequencing victories that could build political momentum to show that this kind of financial change could actually be possible? You start municipal. Are there big states that are big signalers? Would getting some of the federal stuff that you all talked about in the unfinished mission, is that the highest and best use of our political resources? How do you think about that?
I mean, I can start, and maybe this is a cheap shot answer, but I think that it's kind of both. I think it's both and. I mean, we do have limited resources, so it's not that at one level we can't do everything, but at another level we sort of have to. And I think the lemonade part of the lemons of there being relatively few groups focused on this work is that I think, on the other hand, it is a strength that we actually all talk to each other well and often, and we have had to, and to do better, we will have to still more think about how we think about choosing campaigns that build power and capacity in order to then have the power and capacity to take the next one, to take on the next ones, and that it's about, in some cases, the same institutions mobilizing some of the same and some different people who are then ready for the next. So it's about what's, where we have the combination of the opportunity and the capacity in any given moment, and thinking about how we then make that a springboard to the next level of activity, is sort of how I think about it. Well, it's partially infrastructure. So it's partially, where's the infrastructure strongest? It's partially, where is there an opening? So we have somebody friendly with power who we can make do something that gives us a win. And I think those are sort of, where do we have a capacity? Where do we have an opening that we are in a position to take? And where do we have something that has an impact and mobilizes and brings in large numbers of people? I think of those as sort of the three decision criteria. The problems are everywhere, sadly. Yeah, we have it's a target-rich environment. I think New York rates extremely high for a whole bunch of reasons. Oh, that's good. That's a good question. Which was, are you thinking about the city or the state? Yeah, yeah. I mean, it seems to me for a whole variety of reasons that New York City is an extremely interesting place to do a bunch of this work.
City, but it doesn't necessarily have a federal equivalent. And sometimes it's very clear that you don't see a national reform in the short term, but we think we can move things in states that might build some momentum towards national reform. So I just wondered how, in some of the things you talked about, what's the longer term strategy building this up.
One thing that I would say on that, especially in something like local principal reductions that just drives banks so crazy, as we get more and more cities in, what we're doing more than or maybe equally as much as helping the folks in those cities, which is fantastic. It's also building an amazing amount of leverage, right? Because banks don't want it to take off like wildfire. So then, like I said at the beginning, our goal is not to seize the loans by eminent domain. Our goal is principal reduction and to keep folks in their home. So that creation of leverage is equally as important as actually getting it done in those specific cities.
I think I would sort of add to that using actually the same campaign, like in the local principal reduction campaign, that, I mean, the idea really is how do you do enough places that then you can force the broader negotiation, because the fact is that we don't want to have to run a Richmond style campaign in 50 different cities. Like that takes a lot. It's a lot, right? So I mean, and so that's reality with similarly with things like a public bank campaign. If we had to do that, we wouldn't necessarily want to have to do that in 50 different places. And so the idea really is how do you actually, especially in places where you start in cities where you have strength. Usually it's cities before states, because most of the organizations we work with have a stronger base at the city level, although in some cases it is states as well. So you start at either city or states, and then try to figure out how do you actually have enough places that amount to something, and can then really try to reach a tipping point to try to have federal solutions, or make the federal solution more possible, and then try to actually win stuff in the interim. So there's a long-term goal of trying to win the big thing at the national level, but then there's measurable goals at the interim level where you can get both real wins for people on the ground, but also real wins that actually help you move towards a longer-term goal.
On the very sort of nitty-gritty level, it is an advantage of a federal situation where we have a lot of regulatory opportunities that we can make something of any combination of good local activity, because we don't have to count to 50 or 60 or move a vote in Kansas in order to get there. We have to, I mean, it can be particularly hard to hold people accountable. They're not elected. There's not an on-off switch, but it means that if we can tell a story through strong local activity, that we have an ability to affect very important policy in this area in a way that we don't have. And then also really practically, it's just, taking the example of the local principal reduction campaigns, the same organizations and individuals who are mobilized around those local campaigns are helping to drive the continued national conversation around it because of the energy and because of the detail of the narrative in those places and because of the demands that they're making. The national data, that is the data people are citing all the time right now about the continued concentration of homeowners being underwater in lots of communities, was pushed out by these campaigns because the campaigns needed it for a specific reason, but it then is giving a much broader set of people who aren't in a position to fight and win that very, very hard fought piece in their community a piece of something to grab onto that allows them to contribute to the national conversation and perhaps also make other local progress.
Just to throw in another thing, one thing you see with a lot of the city level and municipality level stuff is that there's a big question mark over it, and so the moment it's pushed forward, it kind of clears the air over what would happen. Like in Richmond, I think one of the biggest problems they had at the beginning was a lot of financial firms would say, if you do this, we're going to destroy your credit. And it wasn't clear whether or not that would happen because it's not been tried like that before. And then they initiated it and it survived, and then they got credit on better terms a few months later. So it was like, oh wait, that didn't happen, and your biggest threat did not materialize. And so that opens it up for a lot of other people. And there's reasons why we would, you can imagine how the municipalities go to states, which influence the national conversation, which influences the federal level. There's specific reasons we're worried about the feds influencing the local level. So like the CFPB was purposely designed to have limitations on preemption and its ability to go around and throw its weight around municipalities, because there's a terrible history of that with the housing bubble. That said, there's a lot of liberal senators, a lot of regulators who are very open to things, but need liberal and activist groups to kind of point the flashlight on where it needs to go. Things like dual tracking and servicers was something that was flagged by the activists, and the senators pushed it very hard, and it became less of an issue. Things like who would be the next Fed chair, and how worried we should be about that person. How much could they impact financial reform? The activist groups made a very definitive answer on that. There, I think they have a lot of autonomy to do stuff. They can't fundamentally change things necessarily, but they can push a lot of things as long as they have groups kind of pointing them in the right direction, which is what we're hopefully trying to do.
Series of 6 sessions, right? Even if people don't like Wall Street, there's different entities, different targets in each sector, where it's either so obvious who they are, or that they are actually part of the same problem. So that strategically, to make things more complicated, more difficult, in fact, we have to talk not just about Wall Street, but the interconnection. That's not messaging, but lies beneath it, and we're not yet. Our oppositions for 40 years said government doesn't work. And we said, yeah, you're sort of right. And when we go, well, I'm saying, oh gosh, the market doesn't work in all sorts of places. Your local grocery may, but the market for market, the market, is a very broad instrument. And liberals and the rest have been backing away from saying that for the last, since the Carter administration. It's a tough thing to say. I don't have messages. But until we start to approach that and figure out how to talk about it and how to talk about the appropriate role of government, the necessity of government, then the 6 series on the town that we're having here still fall apart. They still are compartmentalized. So until we can deal with how we talk about government positively and do a sharp critique of the market, we're still strategically in trouble. But I love the tactical growth.
The one thing I'd say about that is I actually think, I think it's a good question, and that the Wall Street conversation provides in a number of ways very, very good opportunities to make progress on it, because I think a bunch of the conversation you've heard today and the things people are saying in these campaigns all the time, that actually does seem obvious to people if in the context of talking about Goldman Sachs or sort of other pieces of giant Wall Street, that letting them run the show, letting them make the rules, letting them to decide what works doesn't work. It caused a catastrophe. And so thinking about what we do with that message, I think is an important part of thinking about the question that you raise. And on the sort of affirmative side, I feel like it has really been a part of the thinking about the Consumer Bureau and about how we talk about it and how we make sure it does the job that we want it to and need it to, and that it remains accountable to that mission, is to think about how to tell a positive story about what government can do, has to do, needs to do, and is succeeding in doing in shaping the market and in making it work better. So. We should ask the views of the group. Should we do one last question?
Why don't we take them both at the same time? And if we have three of Zoe's questions, and then we can maybe just have one of you answer, and then we'll wrap.
So I was just thinking a little bit about, many of us have worked in different social movements where convincing the public to care is a really heavy lift. And in this arena, you've been handed it like a gift. Like, people are being screwed every day and, sort of instinctually know what's happening. And one thing that I haven't seen happen yet, and maybe you all are thinking about it, is how to begin to hold members of Congress accountable for the votes that they have already taken. So, we now have a track record on, their positions towards the Financial Bureau, derivatives reform, so there's votes on record, and I don't know who's looking at that, communicating it back to voters and saying, like, you've got a terrible congressperson on the issues that you care about, and beginning in very practical ways to mobilize that anger and that frustration. And I think, you know, in some ways it also becomes a way to test some of the communications tools and messages, you know, like, I don't know that we have to go hire a bunch of pollsters to figure this out, but to begin it through organizing, to begin to say what sticks, what doesn't, where do we get traction.
So since I know this is a C3 conversation, and that's a very great C4, but we're at Philanthropy New York, so I just want to protect Philanthropy New York. I think that's a good conversation.
Voter education.
Right, voter education. That would be
Okay, here's a question from left field altogether. We've been talking about reform of U.S. regulations and community activism here while we all live in a global economy. And I can even imagine two arguments. One, that the U.S. is such a big player that it's very important to pay attention to the U.S. first, and we live here. The second is that other industrialized democracies should be networked with activists here so that we're all kind of working on the same side. But my question is, does the picture change in relation to emergent economies and non-democratic states? And is there a new framework that needs to be in place for activists in China, Uganda, Saudi Arabia?
All right, how do we want to handle two big important questions? One of them, which
I
comes
don't
before-
expect a complete answer to this, so don't worry about
I have a
that.
couple things to say about that.
Wow, yeah, that's hard. You know, obviously, the regulatory harmonization, air quotes, with Europe is a big point of contention that people are fighting about. And there are bad actions in Europe by U.S. financial firms that were influential in creating a furtherance of a narrative that reform was needed back in 2009, 2010, particularly thinking of Goldman hiding a lot of Greek debt from creditors that blew up very quickly and forced a lot of austerity that shouldn't have been necessary. You know, I think right now everyone thinks in terms of the liabilities of it. You know, the idea that a hedge fund could start a postal bank in, you know, the Cayman Islands and ignore a lot of U.S. regulations. There's been a lot of effort to kind of push that, and then also push harder, stronger regulations in the U.S. than are in the EU, which is a big point of contention Lisa can really follow up on. But yeah, I think in terms of developing countries, I mean, that's something we have to think a lot about, particularly how our financial sector affects them. I think you see a lot of stuff with capital controls and hot money and a lot of the East Asian crisis of the 90s. But you know, we should think more about how to harmonize that with what we're arguing for and try to fight against.
Institutionally, I'd say there's a set of, you know, civil society organizations in Europe and some in the developing world who are focused on this and who know that they want to be talking to each other more, and it's a resource constraint that they're not. You know, that people are so busy with their own country. So that's one thing I'd say. The other thing, and Anna knows this is a hobby horse of mine, but I think that the issues around commodity speculation are particularly ripe for cross-national organizing and particularly important, and that's would really be an interesting place to be able to invest more resources, because that's a place where people in the global south and the majority of folks in the US and in Europe have the same interest as against a tiny number of financial firms, where many real economy firms have a shared interest with you know, real people in the US and in the global south, and so there are plenty of challenges, but I think there's really a ripe opportunity for organizing there. All right.
Well, I don't know if this is speaking to Mike, but thank you guys all so much for coming. I just want to, I'm going to follow up with everyone's email to make sure that you have the contact information for our incredible speakers today. Thank you so much for your time, and I do hope that if you have any questions, that you feel that you do reach out to the four of these folks or to any of the hosts, The Edge, Edge Funders Network and the hosts of this particular convening. So thank you all for coming.
Thank you so much.
Tired.
Okay, so I have two conversations.
I looked at